I've heard the phrase the new normal. PIMCO CEO Mohamed El-Erian used it to describe the post-crisis environment of slow growth, high unemployment, and deflationary pressures. Now PIMCO's Richard Clarida is taking the concept a step further. He says a new normal world is one where investment returns are less predictable and so-called fat tail or black swan type events will be more common. Rich is the global strategic advisor at PIMCO. PIMCO is the manager of the world's largest bond fund, and Richard is also a professor of economics at Columbia University and a former assistant Treasury Secretary in the George W. Bush administration. He is here with us today, and Keith McCullough, the CEO of Hedgeye Risk Management, is with us for the better part of the hour. Richard, let's get into this conversation right away. What do we mean by a world of less predictable outcomes and fatter tails? I mean, what does that mean to the investor? It sounds, frankly, kind of scary, especially given what people have said about models going into the crisis and how they failed us.
Well, I think it means three things for the investor. Number one, it means that the old rules of thumb probably don't apply. In fact, could be misleading. We went through a period of 20 years with a lot of leverage in the system, with very little volatility, and the new world's going to look a lot different. I think the second implication is get used to a lot of risk on and risk off days. Because investors have less confidence, they're going to be changing their mind a lot. And then the third implication is there will be less leverage in the system. Over and above what the regulators do, the financial markets are not going to supply the leverage that we've seen in the past.
Let's talk about how this relates to some of the things that we're seeing right now. Today is an important day for Europe. We have the stress test results coming out. Explain to us how this different distribution pattern, as it were, and we have to make sure that everybody understands what we're talking about there. It's no longer a bell curve, right? It's going to be a flat curve, and it's going to have these tails at the end. What does that mean if you're looking at Europe as a sovereign debt investor?
Well, interestingly enough, I think today may not be the event. I think the impact of the stress test has been the last 2 months that people have been anticipating them, trying to figure out what they mean. So I think one of you just said, you know, to sell the rumor, buy the rumor, sell the fact, and I think that may be what goes on today. But I think the impact of the stress test has been increasing the volatility we saw the last couple of months.
It's a very interesting case, and I agree with you. Basically, you're creating a government-sponsored environment of amplified volatility and shorter economic cycles. So in between all that, do you think that people's kind of risk management exercise or risk on, risk off will be surrounding, you know, are we double dipping? Are we accelerating? Are we double dipping or not? Do you think that that's basically what's going to go on?
Absolutely, and in particular because the recoveries from financial crises tend to be disappointing and sluggish. There's a lot more at stake. It'd be one thing if we were growing 4% a year, but volatility with a low average growth rate is a much scarier proposition.
Richard, in this great piece that you published on PIMCO's website, you talk about how James Carville, who once said he wanted to be reincarnated as a bond vigilante, might want to be reincarnated as something else. What is that?
Yeah, the Asian stock markets. I wake up at 5:30 every morning, and the first email I get is people saying, well, today's a risk-on day because the Nikkei was up. Right. And then tomorrow's not a risk-on day because the Nikkei was down. And so the fact that the entire global financial system depends upon Japanese equity markets is a pretty striking thought.